the challenge going forward is that once the debt ceiling is resolved, because now that cash drain from the treasury is pretty much done. They pretty much, they spent the last 6 plus, maybe 9 months offsetting the Federal Reserve, and now they can't do that anymore. And worse than that, if the debt ceiling is resolved and they're able to issue a lot more debt, their target long term is to get the Treasury cash account back up to $500 billion. So, $500 billion roughly that they want to increase. So they want to suck liquidity back out of the market while the Federal Reserve is still sucking liquidity out of the market. And so we risk going from a sideways liquidity environment to a deeply negative liquidity environment unless one of these entities blinks and changes course.
The debt ceiling is the night of the living dead of the financial markets. A long-forgotten piece of zombie legislation that hasn't been discussed in Congress since it was first introduced. When some brave posse of partisan stalwarts arrive, it rises and pursues the earth. With a continuing resolution, a short-term funding measure, or any other strategy to postpone the issue until later, we can perhaps put it back in the ground. Lyn Alden expresses her opinion on the debt ceiling, the potential for a nominal default, and the effects of this on liquidity in this video. When it comes down to it, Lyn says, the president could potentially invoke the 14th Amendment, order the Treasury Secretary to ignore the debt ceiling and issue net new treasuries in excess of Congress's debt ceiling limit in order to fulfill previously agreed upon obligations if the U.S. federal government is on the verge of nominal default because it is prevented by the debt ceiling from issuing new net treasuries to pay off prior maturing bond issuance and fund existing obligations. And then leave it up to the U.S. Supreme Court to decide whether this judgment is challenged later. Let's watch the video and hear what Alden has to say about it.
So the issue is that if that were to be hit, you either risk potentially default on the treasuries, not because they can always print the money, but they have these, again, self-imposed kind of restrictions on how they're going to break down control of it, or they have to start missing some key payments like Social Security payments or military salaries, things like that, because most of the federal budget is not, we think of like the federal government, we think of all the different functions they do, but that's actually a tiny part of the pie chart of government expenditure. The vast majority of government expenditure falls into the buckets of Social Security, Medicare, and military and military adjacent things like veterans benefits, Homeland Security, that kind of stuff. So that's where the vast majority of spending is. And so when you have that debt ceiling, you either start defaulting or you start having to cut spending. And we've been in this period since January where they technically ran into the debt ceiling limit, meaning they couldn't issue net new debt, but then they still had a number of levers that they could pull in order to not actually run into those more severe consequences. The biggest one that they can do is that the Treasury has a cash balance that they hold at the Fed. The Fed is, like their checking account. They hold their cash balance at the Fed, and so they always have some amount of working capital. Currently, they target to have around $500 billion. So they have this, like, if you were to say lose your job, like lose your income sources, and you can't issue any more debt, what you'd have to do to maintain your expenses, you'd have to start drawing down on your savings. And so essentially, that's what they've been doing since January, and now we're getting to the point where they're almost out of their cash balance, and they've already used some of the other levers that they can pull. And so now they actually start to hit the crunch time for either it's going to be extended or certain payments are going to be missed. Even the holders of these long duration treasuries are still kind of assuming that even if there's a technical default, they will be made whole some days or weeks later as that's reconciled. From a macro perspective, beyond whatever last minute deal or technical default or whatever they do, for me the question is, once they get it resolved, what is the next steps for liquidity? So to answer your other question, if you go back, ever since early 2022, the Federal Reserve has been doing quantitative tightening, where they're reducing their balance sheet, and then they're also separately raising rates, and so they're trying to tighten monetary conditions. If we look at the quantitative tightening, what that means is that they let some of their existing bonds mature, and then rather than reinvest those as they would, they just don't reinvest those, which means that as the Treasury needs to reissue them, some other buyer has to come in and buy them. And so the Federal Reserve is basically slowly destroying base money and reducing their holdings of mortgage-backed securities and treasuries, which means those securities have to be absorbed by other participants in the market. It's very similar to if they were to sell them, with some minor technical differences because they don't realize like a loss or anything like that. They just let them mature, um, and that's been a liquidity drain. And liquidity drains are very correlated with kind of negative asset pricing. It's not great for markets. QE is kind of like inflation for financial assets. Um, and but that's been somewhat offset over the past 6+ months by the Treasury. So, the market did very, very poorly, especially in the first half of 2022 and extending into kind of the autumn of 2022. The market did very poorly. That's when you had just the Federal Reserve is drawing down the liquidity. And while they continued doing that since then, the Treasury started offsetting them starting around autumn of 2022, especially. And so the Treasury, like I mentioned, has this cash balance, and theirs was above target. They had more cash than usual in their Treasury General account, and we can think of that as almost like a void. They previously issued more bonds than they spent, and so they pulled in capital. They pulled in capital from the banking system and elsewhere, and they're storing it in this void that's not really being used for anything. So it actually kind of pulls liquidity out of the market while they grow that cash balance.
Okay.
Now, when they start reducing that cash balance, they're starting to spend it back into the market. They're basically pulling it out of this like liquidity void and putting it back into, circulating liquidity. And so as they draw down their cash balance, it's pro liquidity. And so ever since autumn of 2022, they've been roughly offsetting the Federal Reserve's quantitative tightening. They've been putting liquidity into the market about as quickly as the Fed's been removing liquidity from the market. And so liquidity was going down for the first, say, 3 quarters of 2022. But ever since then, liquidity's been going sideways. And if you look at the reason that's relevant, and this sounds very jargony, but the reason it's relevant is because the dollar index peaked in autumn of 2022, right when liquidity indicators started going from down to sideways.
Yes.
The S&P 500 bottomed right at the same time. The Treasury market in that autumn period was getting very illiquid. You were starting to have like bad tailing auctions. The move index was like at like record highs. It was a really kind of messy Treasury environment. And that's also when the UK gilt market broke. It just outright broke, and the Bank of England had to come in and do like emergency QE to save the UK pension system and prevent like this like spiral, this like liquidity spiral. And so that like transition to a flat liquidity environment was relevant for a broad swath of assets.
Following up on the upbeat comments made the day before by President Biden and House Speaker Kevin McCarthy, there was originally considerable anticipation that an agreement could be struck during Tuesday's negotiations. After stating in the Oval Office that he believed we could find common ground at the end of the day, McCarthy allegedly told Republican colleagues in a private meeting that they were still far from a compromise. As June 1st X approaches, the date Treasury Secretary Janet Yellen stated a default is likely to occur. The back and forth has markets on edge. Our underlying hypothesis continues to be that the debt ceiling will be eventually raised or suspended, even though the process of getting there might take place at the very last minute and result in much greater market turmoil than anticipated by the market. The chief U.S. equity strategist at J.P. Morgan, Braco Liquos, stated in a note on Monday that, "We expect a temporary/comprehensive deal on the debt ceiling to negatively impact federal spending, and for a likely contentious budget negotiation process later this year." S&P Global's flash report on the economy, the U.S. Composite PMI, which measures activity in both the services and manufacturing sectors, increased from 53.4 in April to 54.5 in May, exceeding the economist's estimate of 53.0 and showing a 13-month increase for the index. Separately, data from the Census Bureau shows that sales of new single-family homes increased by 4.1% in April, to a revised yearly pace of 683,000, which is lower than the previous rate of 656,000. This is higher than the 665,000 unit consensus prediction from Bloomberg for April, and is still 11.8% over the level of a year ago. While conversations and discussions are underway, investors are on edge due to the lack of certainty regarding the conclusion. It is impossible to ignore the potential impact on federal spending and market turbulence as the days march down to the June 1st meeting. The market is anticipating a resolution to the impending debt ceiling debate. How do you believe this situation will develop in the face of these difficulties? Post your ideas and viewpoints in the comments section. Also, don't forget to set on notifications for new videos, subscribe, and give us a big thumbs up. I appreciate you guys for watching this video.